on January 27, 2025. In a single day, nearly $600 billion vanished from one company, the biggest one-day loss in stock market history. The tech-heavy Nasdaq plunged 3.1%, nearly $1 trillion in U.S. tech sector market value wiped out in hours. What caused this chaos? A bomb? A war? An economic crisis? No. A small startup from China built an AI model for just $5.6 million that does what American companies spent hundreds of billions to achieve. In that moment, investors realized something terrifying. Everything they believed about AI might be wrong. Right now, as you watch this, tech companies are spending more money on AI than any technology in human history. Amazon, Google, Meta, and Microsoft are set to collectively spend around $400 billion on AI this year. But here's the question nobody wants to answer. What if it's all a giant bubble about to burst? Today, I'm going to show you why the AI financial bubble is real, why it's bigger than the dot-com crash, and why we might be living through the early stages of the most spectacular collapse in tech history. Part 1. Understanding the bubble. Let's start with the basics. What is a financial bubble? Imagine you're at a party. Someone mentions they made $10,000 buying a rare trading card. Your friend hears this and buys 10 cards, hoping to flip them for profit. Then their friend buys 100. Then strangers start buying thousands. Prices skyrocket, not because the cards are actually worth more, but because everyone thinks someone else will pay even more tomorrow. That's a bubble. When the price of something rises not because of its real value, but because everyone expects it to keep rising. Eventually, reality hits. Someone tries to sell and can't find a buyer. Panic spreads. Everyone rushes to sell at once. Prices collapse. People lose fortunes. This has happened throughout history. 1636, tulip mania. People in the Netherlands paid the price of a house for a single tulip bulb. The bubble burst. Fortunes vanished overnight. 1929, stock market crash. Everyone thought stocks would rise forever. They didn't. The Great Depression followed. 2000, dot-com bubble. Internet companies with zero profits had billion-dollar valuations. Reality caught up. Trillions evaporated. 2008, housing bubble. Banks thought home prices would never fall. They did. Global economy collapsed. Now, here's the terrifying part. Every bubble has the same warning signs, and AI is showing every single one. Let me show you. Part 2. The warning signs. Warning sign number 1. Insane valuations. OpenAI's value more than tripled from $157 billion in October 2024 to $500 billion the following year. Think about that. A company that loses billions of dollars every year is now valued at $500 billion? OpenAI is projected to reach $13 billion in revenue in 2025, but they're spending far more than that. They're not profitable. They're hemorrhaging money. Yet investors keep throwing billions at them. Why? Because they believe someday this will pay off. The S&P 500 is trading at 23 times forward earnings, approaching levels not seen since the dot-com bubble. Warning sign number 2. Circular money flows. Here's where it gets weird. Pay attention to this. Nvidia is investing $100 billion in OpenAI. OpenAI counts Microsoft as a major shareholder, but Microsoft is also a major customer of CoreWeave, where Nvidia holds significant equity. Let me simplify. Company A invests in Company B. Company B uses that money to buy products from Company A. Company A calls this revenue, and its stock goes up. It's fairly common at a small scale, but unusual to see it in the tens and hundreds of billions of dollars. The last time it was prevalent was during the dot-com bubble. This is like me giving you $100, you buying my old laptop for $100, and me telling everyone I made a successful sale. It's artificial. Warning sign number 3. Massive debt. Remember 2008? The housing crash happened because people borrowed too much money for houses they couldn't afford. Now, analysts at Morgan Stanley estimate the debt used to fund data centers could exceed $1 trillion by 2028. Meta and Oracle are tapping private equity and debt to finance data center buildouts. When companies can't afford their massive investments with their own cash, they borrow. If AI doesn't deliver the returns they promise, that debt becomes a catastrophe. Warning sign number 4. Everyone admits it's a bubble. This is the wildest part. The CEOs are saying it. OpenAI CEO Sam Altman said it's insane that some AI startups with 3 people and an idea are receiving funding at high valuations, calling it not rational behavior. Demis Hassabis, CEO of Google DeepMind, said it feels like there's obviously a bubble in the private market. Even the people making billions admit this isn't sustainable. But the money keeps flowing. Why? Because stopping means admitting you were wrong, and nobody wants to be the first one out. Part 4. The DeepSeek Earthquake. Now let's talk about January 27, 2025, the day everything changed. A Chinese startup called DeepSeek released an AI model called R1. DeepSeek spent just $5.6 million on computing power for its base model, compared to the hundreds of millions or billions of dollars US companies spend. And here's the kicker. It performs just as well as the expensive American models. The market freaked out. Nvidia's shares dropped more than 27%, losing nearly $600 billion in market value, the largest one-day loss in American stock market history. Semiconductor stocks suffered steep losses, Broadcom down 17%, Marvell Technology down 19%, Micron down 11%. Why did this happen? Because the entire AI investment thesis collapsed in a moment. American companies have been saying AI requires massive investments in expensive chips, enormous data centers, and hundreds of billions of dollars. Only we can do this. DeepSeek proved that wrong. They built competitive AI for a fraction of the cost using older, cheaper chips. Suddenly, investors asked the question they'd been avoiding. If AI can be done cheaply, why are we spending hundreds of billions of dollars? The answer is uncomfortable. Maybe we don't need to. Mark Andreessen, one of the world's leading tech investors, called DeepSeek one of the most amazing and impressive breakthroughs I've ever seen. Even the competition admitted DeepSeek changed everything. Part 4. The math doesn't add up. Let's talk about the numbers, because they're absolutely insane. Consultants at Bain estimate that AI infrastructure spending will require $2 trillion in AI revenue by 2030 just to justify the investment. Read that again. $2 trillion in revenue every year. That's more than the combined 2024 revenue of Amazon, Apple, Alphabet, Microsoft, and Nvidia. If they fall, the entire market follows. Here's an example of how crazy it's gotten. OpenAI is committed to investing $300 billion in computing power with Oracle over 5 years, $60 billion per year. OpenAI's projected revenues are $13 billion in 2025. They're spending 5 times more than they earn. How is this sustainable? It's not. An MIT report stated that despite $30 to $40 billion in enterprise investment into generative AI, 95% of organizations are getting zero return. 95% are getting nothing. Companies spent billions on AI tools that don't generate revenue, improve productivity, or solve real problems. They bought the hype.
Part 5. The 3 ways this ends. So how does this bubble pop? Let me show you 3 scenarios. Scenario 1, the slow leak. AI doesn't fail dramatically, it just disappoints. Companies keep spending billions, but the promised revolution never arrives. AI chatbots remain helpful, but not transformative. Self-driving cars stay 5 years away forever. Productivity gains are modest, not revolutionary. Investors slowly realize returns won't justify investments. Stock prices decline gradually over months or years. Companies write off billions in losses. No single crash, just a long, painful deflation. This is the soft landing scenario. It still means trillions in lost value, just spread out. Scenario 2, the competition collapse. More companies like DeepSeek emerge, proving AI can be done cheaply. The expensive American infrastructure, Nvidia's chips, Microsoft's data centers, OpenAI's massive models, becomes obsolete. Companies that devoted about 50% of their current cash flow to data center construction suddenly have worthless assets. Stock prices crash as investors realize they backed the wrong technology at the wrong price. This is the disruption scenario. The iPhone killing BlackBerry, Netflix destroying Blockbuster, but on a trillion-dollar scale. Scenario 3, the debt bomb. The design involves special-purpose vehicles, the term that came to consciousness about 25 years ago with a little company called Enron. Remember Enron? They hid debt off their balance sheet until it all exploded at once. If the AI bubble bursts and data centers go dark, companies face multi-billion-dollar payments on debt they can't afford. Banks that lent the money face defaults. The financial system wobbles. Credit freezes. Companies can't borrow for anything. Economic recession spreads beyond tech. This is the contagion scenario, 2008 all over again, but starting with AI instead of housing. Which scenario happens? Maybe all 3 at once. Part 6. Who gets hurt? You might think, I don't own tech stocks, so this doesn't affect me. Wrong. If you have a retirement account, it probably owns tech stocks. 30% of the S&P 500 is held up by 5 companies. Your 401k, your pension, your mutual funds, they're all exposed. If you work at any company, your employer likely uses cloud computing from Amazon, Microsoft, or Google. If those companies struggle, your costs go up or services disappear. If you're investing in startups or innovation, funding will dry up instantly. When big tech crashes, venture capital vanishes. Nobody invests when fear dominates. AI-related capital expenditures surpassed the U.S. consumer as the primary driver of economic growth in the first half of 2025, accounting for 1.1% of GDP growth. If AI spending collapses, economic growth collapses with it. Here's what makes this bubble different from previous ones. The dot-com crash hurt investors, but most people didn't use the internet daily yet. The 2008 crash hurt homeowners directly, but AI is being built into everything. Your phone, your car, your bank, your hospital, your job. When this bubble pops, it won't be isolated to Wall Street. It will touch everyone. Conclusion. Let's come back to January 27, 2025. Nearly $600 billion vanished from Nvidia. The Nasdaq plunged, $1 trillion in market value wiped out. And then something strange happened. The next day, Nvidia surged nearly 9%, recovering from its worst performance since March 2020. The market bounced back, for now. But this wasn't a false alarm. This was a warning shot. Sam Altman said, "Someone is going to lose a phenomenal amount of money. We don't know who." The AI bubble is real. The question isn't if it pops, but when and how bad. Every bubble looks unstoppable until the moment it isn't. Every time people say this time is different, it never is. But here's the thing. Bubbles aren't all bad. The dot-com crash destroyed hundreds of companies, but it gave us Amazon, Google, and the modern internet. The AI bubble will crash. Billions will be lost, companies will fail, but the technology that survives, the real AI applications that actually work, will change the world. The question is, are you ready for what comes next? If this video just changed how you see the AI boom, here's what I need from you. Hit that like button because this information is critical for anyone investing in tech, working in the industry, or just trying to understand where the economy is heading. Subscribe and turn on notifications because we're tracking this story as it unfolds. When this bubble pops, and it will, you'll want to know what's happening and how to protect yourself. Share this with anyone invested in tech stocks or excited about AI. They need to understand both the potential and the risks.
Drop a comment. Do you think the AI bubble will burst in 2026, or will the technology deliver on its promises? I genuinely want to know what you think. Thanks for watching. Stay informed, stay skeptical, and remember, when everyone says something can't fail, that's exactly when you should worry. See you in the next one.